in this chapter of chapter 19 partnership, you will be able to learn, after you learn this chapter, you will be able to explain the advantages and disadvantages of forming a partnership, and then outline the importance and content of partnership agreement. Yeah. Explain the purpose of an appropriation account. We will create a new account called appropriation. And then as usual, income statement, statement of financial position, and appropriation account. Okay. Now, previously in a sole trader, you only knew two financial statements. The first one is income statement. The second one is statement of financial position. For partnership, since the ownership is changed, yeah, we are required to create one new statement in the middle. Yeah. So we have income statement. After income statement, you have to do appropriation first. After that, SOFP. Okay. So previously, we don't have appropriation, only income statement and statement of financial position. But in partnership, we do have new statements in the middle. Appropriation account. We will learn about it, yeah? And then record interest on partner's loan, interest on capital, interest on drawings, partners' salaries, and the division of the balance of profit and loss. This means that profit sharing. Yeah. So we should share the profit. We should share profit or loss among partners. Yeah. And then we also learn adjustment to the financial statements. We do have learned about adjustment before. What is actually adjustment? Accrued, prepaid, depreciation, provision for doubtful debts. Yeah, all of these are adjustments. Yeah, so we still carried previous chapters in this chapter also. Yeah. Next, explain the use of differences between capital and current account. So for partnership, if you go back to this part, Chapter 9, Financial Statements of Part B, which is SOFP, you will see a capital part in the SOFP, which is this part. Yeah. Now, for partnership, we will have two capital. The first one is capital account. The second one is current account. Yeah. Now we will learn about that also. Okay. Next, you are required to draw up capital and current accounts. Okay. In a ledger account form, in a T account form, or as part of a statement of financial position. Okay. So all of these that you will learn in this chapter. Okay. Now, before I continue, since we are learning about three different types of business, sole trader, partnership, and then limited companies, all of these have different ownership. Sole trader owns by one person. How about partnership? Let's talk about partnership in this part. A partnership is a business in which two or more people work together as owners. So previously in a sole trader, we only know that in a business, we have one owner, yeah? Now, we have two or more, okay? But don't worry, the maximum partners is 20 people, yeah? but you will not going to learn about making a financial statements for 20 people. Yeah, it is not on your level. Okay, so you will learn only probably about 2 or 3 partners, maximum 3 partners, never going to be have a 4 or more. Yeah, usually 2 partners usually. Okay, but sometimes um, sometimes it's 3. Okay, so 2 or 3. Yeah, so you should understand that now. Next, partnerships are common among professionals such as lawyers, doctors, and accountants. Once again, yeah, they are professionals, those people who works as professionals. So means that they have their own personal skills. Yeah, like public accountant, yeah, financial analysts, investment managers, yeah. Usually they are working partners. Okay, so people who have this professional's job. Okay, so far any question? No, yeah. So you should understand that we are now move on to a company or a business that owns by 2 or more people. Yeah, but we only focus on 2 or 3 people. Okay, 2 or 3 people. But in the regulation, maximum partners in the partnerships is 20 people. Okay, that's the rules, the standard rules internationally. Yeah, but we are learning only 2 or 3 partners. Okay, we call it as partners, not owner. Yeah, so if I say 2 partners means 2 owners. Okay, so you should familiar with the terms that I used. Yeah, partners. Okay, now what is the advantages, what are the advantages and disadvantages of partnerships? The partnership advantages you see over here, partnership are simple and cheap to set up, just like sole trader. Yeah, it is easier to raise capital for the business as each partners will contribute financially. Okay, partners may have different skills which work well together. Yep, and which will enable the business to benefit. For example, Daniela and Isi. Yeah, Daniela have a good communication skill in front of people. Yeah, so she has this confident and um, public speaking skills that Isi don't have currently. Yeah, but Isi has this skills of designing. Okay, so they want to have a business together, they want to work together as a partners and create, for example, an advertising company, yeah, or marketing company, something like that. Yeah, digitally or non-digitally. Okay, so both Isi and Daniela have different skills and they complete each other. So they work, they join together because they have their own personal skills, which is benefited to the company, and they join together to make a partnership. Yeah. So again, partners can work inside the partnership. Or let's say we have Isi, yeah, before, yeah, and then we have Daniela. And then the third person, let's say Angel. Angel wants to jump into the partnership. Yeah, but Angel doesn't have any skills. For example, yeah, it is just example. Yeah, uh, and then but Angel have a lot of money. Let's say, okay, so can Angel join the partnership? But she's not working inside the partnership. She just want to become uh, the owner who will get a profit sharing at the end of the accounting period. Is it possible? Yes, it is. Yeah. So it depends on how are you going to create the agreement between the three of EC, Daniela, and Angel. Okay, let's say one of the example of partnership agreement. Since Daniela and EC are working inside the business, so they will get salary. But Angel did not, because Angel is not working inside the company. Okay, so the second one about profit and loss, since they are the owners and they are working together inside the business, they have contribution to the business. Now we have to think about how are we going to share the profits. When the business have these profits, we have to share among them. Yeah, the business have to share among EC, Daniela, and Angel. Okay, how are they going to distribute this profit? It depends on the agreement. Let's say since Angel is the one who gave doubled on the contributions in terms of finance, yeah, so they can have a ratio. For example, the ratio is Angel 2, Daniela 1, and AC 1. Yeah, so everything must be stated in the partnership agreement. Yeah, then we will study about partnership agreement later on. Yeah, so every single rules that connects them and related to the partnership and partners must be stated in the partnership agreement to avoid disagreement in the future. Yeah, and to avoid fight in the future between the partners. Yeah, so that's example, okay, for contribution. Yeah, and then another one, not only for skills but pool of knowledge can also be shared inside the business. Yeah, next, partners with their own area of expertise will make the business more productive. For example, a firm lawyers could have a partner who specializes in family law and another in business law. So can complete each other. Yeah, partnership can provide for more creative ideas. Yeah, that contributes to good decisions. More head, more ideas. Yeah, but too many heads can make chaotic. Okay, so has to be good in terms of choosing the right person as a team. Yeah, responsibilities and risk are shared between the partners. Of course, since you own the business or the partnership owns by three person, in this case, in our case, yeah, Daniela, EC, and Angel. Yeah, so both three of them are sharing risk and responsibility. If there is a risk, they have to share between the three of them. Responsibilities also. Yeah, and advantages, if the partnership suffer from loss, the losses will be shared between partners. So previously, if it is sole trader, if we have a loss, 100% the loss is for the owners. But if we are in the partners, the loss will be shared among three or two, yeah, or among partners, yeah. Now, we have advantages. We also have disadvantages, yeah. Disadvantages of partnership, of course, profits now must be shared among partners. Previously, we have 100% as sole trader, we have 100% profit for us. But since we are partnership now, we have to share among partners, among our friends, yeah. And in partnerships, usually when the business is small, disagreements very less can occur. But if it is becoming big or it's growing, yeah, for few years, this agreement can occur because the bigger the company is, the bigger the problem is. Yeah. So this agreement can occur. That is why we have to prevent that by partnership agreement. partnership agreement. Yeah. And then as decisions are jointly made, they can take longer. So previously, if sole trader owns by one person, when the owner have to decide on something, they just have to decide just at right that moment. Yeah, fast. But partnership, sometimes it took longer time because we have to discuss first. We had a meeting for among partners. Yeah, something like that. Okay, so it definitely is going to take longer time in terms of decision making. Yeah. All partners are liable for errors made by one of the partners. So all partners will responsible for any errors made by the other partners. One for all. Yeah. All for what? One for all. So if there's a mistake, if there is an error, then all three of the partners must um, share the risk and responsibility together. Yeah. Okay. Last one. Partners or ordinary partnership have unlimited liability. Like a sole trader, this means partnership is very risky. Okay. Now I want to explain to you about this one, about this partnership that has unlimited liability. Does any one of you does any one of you know what is actually unlimited liability? Please. I believe you already learned this in business or economics. I don't know. I think business there. Anyone? Kim said, it does it mean like when they have debts, personal assets can be taken? Yes. Yeah, unlimited liabilities means the liability of the business is also the liabilities of the owners. Remember the part of business entity where business and owners are separated? Yeah. But when the business is bankrupt and this business have a lot of liabilities to pay to, yeah. So after the assets of the business are finished to pay up all the debts, yeah, and it is still not enough, okay. So the personal assets of the owner must also be taken to pay all the debts. So unlimited means there is no gap. There is no what is it called? Uh, like a gate, yeah, like a gate. So if there is a liability in the partners, is also liabilities to the owners. So there's no gate to separate them. There's no gate. Yeah, the liabilities are also the owner's liability. So when a business let's say a business, yeah, is suddenly bankrupt, eh, what is the spelling for bankrupt, guys? Is it like this? Suddenly, Kim, what is the spelling for bankrupt?
The C is like Camus.
Oh, right. Okay, thank you. Personal assets of the owners or partners are also affected to pay the debts to the third parties. Yeah. Okay, that's about unlimited liability. So it is very dangerous in terms of risk. The risk is the same with sole trader. Yeah, the risk is the same with the sole trader. There are unlimited liabilities. Okay, right. Any question? Any question? Response? No? Okay, I continue. Yeah. Now let's talk about partnership agreement. The partnership agreement is not a legal requirement. It is not legal requirement, but it should be considered essential or important because this agreement between partners is one of the major reasons why partnership may fail. Okay, now partnership is a contract drawn up and signed by partners. So clauses that usually inside the partnership agreements are: number one, percentage of ownership. Okay, let's talk about our first example. Isis, Daniela, and who's the other one? Angel. Yeah. So all three of them must have the percentage of ownership stated in the partnership agreement. Yeah, it means it shows how much capital is contributed by each partner. Okay. Partners do not have to contribute equal capital. So there are sometimes partners are contributing equally, but sometimes they are not. Yeah. So contributions equal capital is not a mandatory. Okay. It depends on the partnership. Number two, distributions of profits and losses. This is very important. Okay, because they are joined together to make profits. So definitely how to share that profits and losses has to be stated in the partnership agreement. Yeah, partners may share profits and losses in proportion to capital they have contributed. What is the meaning by proportion to the capital they have contributed? For example, Easy gave 50,000. Daniela gave also 50,000, but Angel gave $100,000. So the proportion of the capital they have contributed is 50 compared to 50 compared to 100. If we simplify them, it becomes 1 compared to 1 compared to 2, 1, 1, 2 in a ratio. Yeah? Or equally. If it is equally, then 50-50, yeah? Half-half. Or in any other way they choose. Yeah, the profit or loss sharing ratio is stated in the agreement. It has to be stated in the agreement, okay? To avoid disagreements. Okay, next one, partners drawings limit. Okay, as a partners, they may have drawings inside the business. Now, it is very important to put down the limits of drawings so that partners cannot draw too much because it will affecting the daily activities of the partnership. Yeah, so it is very important if we have a maximum limit that can be used to partners to take drawings. Okay, and then interest on partnership in partners capital. Okay, this is reward to capital contributed. Okay, interest on partners capitals means when we are talking about number one, partners put in capital in the business. Okay, Now, how much they put in the business, they will get interest out of it. Okay, that is why we called it as interest on partners' capital. It is partnership agreement states the rate. Yeah, so in the partnership agreement, we state the rate in percentage, yeah, of the interest on the capital earned. This is a way of rewarding partners for investing in the partnership. Okay, so it's like a profit from investment. Yeah, and then we also have interest on partners loan. Okay, this is also in the rate. Partnership agreement states the rate of interest on loan from partners. Why? Because sometimes partnerships took loans from partners. Yeah, sometimes partnership took loans from partners instead of the banks. Why? Because it saves time. Yeah, and also cost. If a partnership or a business wants to take loan in the business, they usually took up about 2 or 1 month process, including the cost, like insurance cost, blah, blah, blah of the loan, it might appear. So it's different from, let's say Daniela have more money and then the partnership wants to make loan from Daniela. So Daniela said, okay, just as simple as that. And then Daniela can give the money faster without any cost because that company is owned by Daniela also, right? So first, it saves time. Second, it saves cost also. Yeah. But for every loan, there will always be an interest. So the partnership needs to pay an interest also to Daniela if Daniela give loan to the partnership. Okay. Any question? Clear enough, yeah? Okay, next, interest on drawings. Okay, so this interest on drawings is a charge of cost to partners. Okay, the partnership agreements also state the rate of it, of interest on drawings. Yeah, why do we as a partnership, yeah, have to create this interest on drawings? This is actually a way to discourage partners from making cash drawings. Okay, drawings can affecting daily activities of the partnership. Okay, so in order to discourage, yeah, once we have a limitations on drawings, we also charge an interest. Yeah, so that is why this is one of the way to keep the business runs well. Okay, so this is actually effective. Yeah, if we put interest on drawings quite bigger. Yeah, let's say yeah, percentage of interest on capital is 5%, but interest on drawings, let's say I'll make it 8%. Okay, so it is bigger than what they contributed in the capital. Yeah, so it is one of the way to discourage partners to make drawings. Next is salaries. From the example before, Daniela and EC are those who are working in the business, so they must receive a salary. Okay, salary is a form of reward to partners who work longer in hours, yeah, in the business, or who take on more responsibilities. Okay, the amount of salaries must be stated in the agreement. That's a must. Okay, so I think so that's all. clauses in the partnership agreement that usually appear. Yeah, in reality, it can be more than this, but you only have to learn this part only, the major one, okay? So far, any question before I continue? No, yeah? Okay, good. Now, see, after you learn about the partnership, every business must create financial statements. The first statements is income statement, okay? This is the first one. And the income statement of partnership is exactly the same with the income statement of sole traders. That is why I ask you to look back on the income statement of sole trader in chapter 9. Okay, that is why I ask you to recall it because we will need it. Okay, now once you recall it, this is how it looks for the income statement. Okay, up until you get the net profit and loss. Yeah. After you prepare the income statement, the next statement would be profit and loss appropriation account instead of SOFP. Okay, what is actually profit and loss appropriation account? Appropriation account is the continuation of an income statement where it is made to show how profit for the year is distributed among partners. Profit or loss, yeah? Profit or loss. Because remember, in partnership, since the owner is more than one, so it means we have to have a statement that showing how the profit is separated atau divided, yeah, or divided. Profit or loss divide among the partners or shared among the partners, okay? Now, this is how the appropriation account would look like. First, the name of the company. Second one is the name of the statement, which is income statement appropriation account for the year ended, blah, blah, blah. And then since this appropriation is a continuation of income statement, so it will start with net profit or net loss. Yeah, or net loss. It will start with net profit or net loss that you take from income statement. Okay, after you have it here, you put it here, and then plus with interest on drawings. You have to calculate interest on drawings. We have learned interest on drawings before in the partnership agreement, yeah? So if there is a drawings, partners will be charged with interest on drawings. Okay, now you have to look on from a different point of view, yeah? You are the partnership, not the partners. So interest on drawings will adding the profit. In partners' point of view, interest on drawings will decreasing their profit. But as in partnership, interest on drawings is increasing the profit of the partnership because we get interest from partners, yeah? After it is added with interest on drawings, yeah? And you have to calculate each of them, yeah? For partner A and partner B. Add, and then the result of net profit or loss plus with total interest on drawings, you have this one. And then minus with interest on capital for partner A and B. Why does interest on capital deducting the profit? Because this interest is a reward to partners. So the partnership gave, yeah, part of the profit to partners. That is why it is deducting net profit, yeah? And then put it also separately for A and B. And then the total will be placed here on the first column. And then if the partnership have partners that work inside inside the business, yeah, I'm sorry. If there is a partners work inside the business, they must get a salary as well. Yeah, and the salary must also be placed in the income statement appropriation. Salaries for A and B. Okay, and it also deducting profit. So you put it there and then deducting here. From this amount, deduct with this amount, deduct with this amount, then you have profit to be shared. I remind you that salaries for partners is not going to be placed in income statement. We know in income statement, we have salaries expense as well, right? Now that salaries expense is only for employees, the one that is in the income statement. But salaries for partners is in appropriation. You have to remember that. Okay? Salaries for partners is in appropriation. Meanwhile, salaries for employee goes to income statement. Yeah? Clear, yeah? Okay, so until profit to be shared, do you have any question? No? Okay, continue, yeah? After we have profit to be shared, now this amount that is showing how this will be divided among partners. Now, this profit shares for partner A and B, it depends on how the partnership agreement said. If in the partnership agreement, the profit and loss is shared using ratio, then we are using ratio. If it is based on capital contributed, then we are using capital contributed. Yeah, basically, it depends on how it's stated in the partnership agreement. Yeah, so you have to be able to remember what it is in the partnership agreement. So usually in a partnership case, you will be given with that partnership agreement and you should remember that. Okay. Right, after this profit is shared among partner A and B, the total of this apportionment, yeah, put in the right column or the last column and put bracket. It means it already been shared. After it is shared, then it becomes 0. You have to understand that this result at the end has to be 0. Yeah, has to be 0. This is indicate that you have done shared that profit or loss. Okay. Now the name of this profit to be shared, or if it is a loss, then you can just put loss. Yeah. Loss to be shared or profit to be shared. If it is a loss, then if above is loss to be shared, then on below it is loss shared. Yeah. Clear, yeah? Okay. It's going to be clearer when we are jump into the question. Okay. Next. Okay, Nadia, you can go. E, current and capital accounts of partnership. I was explaining yesterday that in partnership, you will have 2 different capital. The first one is capital account. The second one is current account. Now, what is actually current account? Current account is changes in capital. Meanwhile, capital account is only showing this one, yeah? This one only showing total capital contribution from partners. Okay, now we have capital account that only showing how much capital is contributed from each partners, yeah? But current account is showing changes in capital account based on daily basis activity. Now, what I meant by daily activities. What it meant by daily, don't forget, yeah, daily, it doesn't mean like it is every day. Daily means regularly, yeah. So it can be every month, every day, every week, or every year. Once in a year is also called daily basis. Yeah. Okay, Patricia. Okay.
Yes, yes.
So now I'm going to move on the template for capital account first because this is the most easiest one. So on the capital account, balance BD is usually in the credit side, yeah, normally. So we have balance BD on the credit side. If there's an addition to the to the capital by the partners, you can just add it in the credit side. Now this addition can be in the form of assets, yeah, like premises, motor vehicle, yeah, computer equipment, whatever it is, yeah. Just put the name of the assets, yeah, or in the form of cash, or maybe with a check, okay. Can be assets, cash, or with check. And then don't forget to calculate the balance CD and then carry it down to the next accounting period. Only that, as simple as that. Now, next. Okay, I'm back. I was freezing again. Okay, so for capital account, do you have any question? No? Okay, good. Continue, yeah?
Yes.
Okay, thank you. For template of current account, showing the changes in capital account based on daily basis activities. Now, in current account, there is a possibility that we have two balance, yeah, or not two balance, one balance actually, but it is not always in credit side, yeah. So capital has a normal balance in credit, but for current account, there's a possibility we have a debit balance, yeah. This debit balance might happen if, okay, over here, yeah, debit balance of current account might happen because partners took too much drawings, yeah, or the loss of the partnership, the lost share, yeah, from the partnership is bigger than the reward that received by partners. Okay, so this debit balance might happen because partners took too much drawings or the loss shared from the partnership is bigger than the reward. The reward is, for example, profit shares, interest on capital, yeah, salaries, yeah. Sometimes it happens that will make the current account have a debit balance, means negative balance, yeah. It is not regularly happen, but it can be happen, okay. Okay, so this is the balance BD. Normal balance BD in the debit side is if any, okay. Interest on capital is in credit side because it will adding partners capital account. Yeah, because it is a reward for partners, so it will increasing their capital. Okay, salaries for partners also increasing partners' capital. Profit shares also increasing partners' capital. That is why all of these three will goes in the credit side. Yeah, this 1, 2, 3 will be the same like what you wrote in here. Yeah, so if you are doing the current account of partner A, so interest on capital of partner A will be stated there. In salaries of partner A will be stated here. Yeah, and profit shares for A is also here. Yeah. Now, if it is a loss, then the loss will be shown in the debit side. Yeah, sorry. So loss shares in the debit side, profit shares in the credit side. I already put different color. Yeah, it's impossible to have two of them. Yeah, so either it is either it is profit shares or loss shares. Yeah, drawings is also showing in the current account in the debit side because it will decreasing capital. Okay, interest on drawings is also in the debit side because interest on drawings is something that is charged to partners. Yeah, so that is why in capitals account, so it will decreasing the capital. Okay, now the one that you need to remember is interest on loan to partner. Interest on loan to partner, if you have an accrued amount of interest on loan to partner, which means that this interest is not yet paid by money, it is still accrued, yeah? You have to write down this interest to partners in the credit side. Why? Because this is part of the business responsibility or the business liabilities. Interest on loan that is accrued to partners means the business owed money to partners. Yeah, that is why in the credit side it appears. Okay, now you might wonder why this interest on loan to partner doesn't show in the appropriation account, because everything related to partners is in the appropriation account. The reason is interest on loan to partners is taken from loan from partners. Loan is not a capital instrument. Loan is liability instrument. Yeah, A equals to L plus C. Asset equals to liabilities plus capital. Now, this interest on loan, whether it is to partners or to third parties, like for example, bank, we still have to record that in the income statement because that is the expenses that is occur from liability, not occur from capital. Yeah. Look over here on the income statement. Let me show you, yeah. Okay, this one. So did you see this one? Interest on loan. Yeah. So interest on loan, even though it is for partners or to third parties, whoever it is, yeah, it will be shown in the income statement. Once again, interest on loan for whoever it is or from whoever it is, yeah, we have to put that in the income statement. Yeah, only that interest on loan, yeah. So if you have interest on loan to partners, do not, once again, do not put it in the appropriation account. Okay? Now, any other else related to partners will be stated in the appropriation. Okay? Clear enough, yeah? I'm going to put it here. interest on loan to partners is not appropriation instrument. Yeah. It is apologies, yeah, once again. Let me close my camera so it is more stable. Once again, interest on loan to partners is not appropriation instrument. It is income statement. IS instrument. Yeah. Okay. So even though it is in the income statement instrument, but it will be shown in the current account. If you have interest on loan not to partners, do not enter it in the current account. Yeah, do not. Yeah, this is only interest on loan to partners. Why I always say this like so many times, because students' common mistake is always in this part. Yeah. So that's it. For current account, do you have any question? Okay, continue, yeah. After you put this interest on loan to partners, if any, yeah, and also if it is accrued. If it is directly paid, which is not accrued, yeah, it means there's no liability appear. If no liability appear, you do not write it down here. Okay, only if it is accrued, yeah. After you put everything in, and then calculate balance CD, don't forget. And the balance CD, it depends on what you enter here. If you have balance CD in the debit side, means positive. If you have a balance CD in the credit side, it means it's negative, yeah? Because if you carry it down to the next counting period, it is going to change place. Right, yeah? Done. That's for capital and current account, yeah? Clear enough for current account? Okay, good. And then after that, once you have current and capital account is calculated in the T account, next step, when you are doing the SOFP, you will combine both of them. Yeah, combine the current account and the capital account. Okay, now how would it look like? Look at this statement of financial position of partnership. From non-current assets to total asset, there's nothing changed. Aduh. Nothing is changed from here to here, yeah? Same way, okay? And then from here to here is also same. Yeah, nothing is different from sole trader. This is also same way with sole trader. Now the difference is in the capital part. Yeah, for the capital part, since you have two capital account, which is current and capital, so you have to separate them like this. So the first one is capital account. In the capital account, you have partner A in a form of column, partner A, and then partner B, and then you put the total. Where did you get this number? You get this number from the capital account here. Yeah, after you create one. Yeah. And then current account for partner A and partner B. This also depends on what you calculate here. Yeah, balance PD and balance PD. If one of the partner has balance in the debit side, then you have to put negative. You have to put bracket. If in the current account of the partner is in credit side, it means it's positive, yeah? So do not put bracket. Only if the partners has a negative balance in the current account, then you put the bracket, okay? And then you total to the right, and then total them between total capital and current account, yeah? Clear enough? Okay, good. Next, other method to show capital and current account in SOFP. Okay, so in this case, for this case, the instruction is that you have to separate capital and current account using T account. But there is a possibility where you are questioned that you have to show how the capital and current account affected but directly in the SOFP. Okay, so there, this is this way is where the current account is shown in full details in SOFP. Yeah, so it means you don't have current account. You only have capital account, but the current account is directly, the question asks you to directly calculate plus minus inside the SOFP. Now we know the instrument in the current account already. We know the instrument, which one is increasing the capital, which one is decreasing the current account and capital, yeah? All of these are adding the current account, yeah? Eventually adding the capital. These items will decreasing current account as well as the capital. Now, the only difference from this way is that when you are required to extract a statement of financial position where you show the current account in full details, so the first one you put the capital account just like in the SOFP before, but when you show the current accounts, you separate between added and deducted. Once again, you already know what's in the current account that's adding the current and what is decreasing. What are the decreasing items in the current account? Yeah, so you just have to put it here, plus, 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 and then minus, minus. Yeah. Oh, I missed one here. Yeah, supposed to be partners drawings. XXX over here. Yeah. Apologize. So XXX. So drawings is one of the decreasing items. So once you have it, once you have it, then you have the total here. The total here will be added to the right side of the total column, and then you add. Okay? So that's the difference between showing current account in a full details inside SOFP, or you are required to do the T accounts. Yeah? Okay? So that's it. Do you have any question?